Good morning, everybody, and a very warm welcome. Thank you all for joining us today. We are here to talk about the A&M Distress Alert, also known as the ADA, which is our biannual report on distress trends across Europe, identifying which jurisdictions and sectors are experiencing the most distress. By way of introduction, I'm Chris Johnston. I'm a Managing Director with Alvarez Marsal's European Restructuring Group based in London, and I sit on the EMEA Restructuring leadership team. I have over 25 years of restructuring experience and specialise in advising stakeholders, predominantly lenders and corporates, in stressed and distressed situations in the UK and also across EMEA. I've got with me today one of my fellow restructuring MDs, Christian Ebner, who is based in Germany. And to mix it up a bit, joining us from Moody's Ratings is Colin Ellis.
Thanks, Chris, and a warm welcome also from me. I'm Christian Ebner, Managing Director and Head of the Financial Restructuring team in Germany. I have over 20 years' experience in advising borrowers, creditors, shareholders, and other stakeholders, and I'm now based in Munich, Germany, to which I returned to start our team there about 4 years ago. Colin, over to you.
Thank you very much, gentlemen, and good morning, everybody. As you've already heard, I don't work for Alvarez Marsal. I'm the slightly odd person who does these things called credit ratings at Moody's. It's not just me, of course. There's thousands of us who get involved in rating sovereigns and banks and corporates and many other things around the world. I think one reason I'm here is I head something called the Centre for Credit Research at Moody's, which does a bunch of more specialised analysis around things like macroeconomic forecasting, bank stress testing. But particularly relevant for today is I head the group that does all of our work around default rates and rating transitions. And that's what I'll try and bring a little bit of a flavour of today. Back to you, Chris.
Thanks, both. Just a little bit of housekeeping. We're going to have a Q&A session at the end. So you'll see at the top of your screen in the Teams page a Q&A button. Please feel free to post any questions here. There is an option to make it anonymous if you would like, and we'll go through them all at the end, depending on how much time we've got available. Okay, so what are we going to talk about and cover today? We'll give a little bit of insight into kind of the ADA methodology just to start with, but then we'll get quite quickly into the overall findings and what the report shows. We'll delve into that on a country-specific level with our focus on Germany, France, and the UK. We'll then, to the extent not covered by the country, look at the various sector insights, and then we'll develop that into what we view as the market going forward from a restructuring perspective as well, looking into kind of end of 25 and into 26. And as I said, the Q&A will come at the end, so please do pose your questions as they come to you. Let's just start with a little bit, before we get into the main element of it, a bit of background on the data we have used as the basis for the presentation today and the ADA alert. Our latest ADA alert was published this summer, and if you haven't already seen it, we invite you all to download it now. You can simply scan the QR code you see on the screen, and by magic it will appear, so it will give you all the latest version of it. To create that alert, we use a proprietary methodology to assess the financial performance and balance sheet strength of over 8,000 businesses across Europe. We've been tracking this data since 2023, and our analysis has proven to be an effective barometer for stress and distress trends in the region. And we've also launched now that same analysis in other markets, including Southeast Asia and Australia. As we go through it, it is worth highlighting that analysis is based on FY24 numbers, so our data set analysed that companies that have submitted FY24 numbers by June 2025, and by FY we mean calendar year. And when we hear from Colin, his data is as at August 2025, so a slightly different sample set, which he will expand on further a little bit later. So we will see some differences, but we're trying to get you the most up-to-date information that we possibly have. Okay, so hopefully you've all got a copy of it or have seen a copy of it. Why don't we go into some of the key findings from that report that we shared in the summer. For us to determine the overall distress levels, the ADA index analyses 18 KPIs to create two subscores: the financial performance score, which is based on the company's own income statement, as well as related KPIs measured against its industry peers, and the robustness score, which is based on the detailed balance sheet data. Just turning to those findings overall, and you can see the chart on the screen there. We've seen distress levels across Europe stabilise in 2024 when compared to the prior year. And while that might sound like better news, it is important to note that these levels are still significantly higher than they were 2 years ago and remain close to the 2021 COVID peak. So what does that actually mean? Our data shows that 8.8% of our data set of businesses in 2024 were in distress. But more importantly to note, in all countries we analysed, over 30%, so just under a third of companies, have weak balance sheets, which is, as we all know, an early warning sign of distress. Generating sufficient cash and profits to service debt remains a major challenge for many businesses, especially with high interest rate, broader economic issues, and geopolitical uncertainty. Given this, and with earnings likely to deteriorate further in the wake of new tariffs, we anticipate more companies in this category could tip into distress over the coming quarters. Okay, so that's the overview. Let's have a look at what that means on a country-by-country basis, where there are quite different economic positions from one country to the next. Over to you, Christian.
Right, thank you, Chris. Looking at this map, you'll quickly see, as an overview of the distressed landscape across Europe and the Middle East for fiscal year 24, according to our ADA, there are some notable differences. Clearly, Germany and France, once again, hotspots and focal points, as our data identified both countries as the most significant and challenging markets from a distress perspective, which as a practitioner in country is very much borne out by recent mandates and the experience day to day. Both countries, Germany and France, have experienced a notable upward trend compared to the previous fiscal year 2023, underscoring a growing number of distressed corporates and an increasing demand for restructuring solutions and expertise. Elsewhere on the map, elevated distress levels are also evident in the Benelux region and the UK, whereas conversely, the Nordics and the Middle East show a positive trend, with distress levels declining slightly year on year. Meanwhile, Italy, Spain, and Switzerland show relative stability in their distress levels. There's a decent amount of activity, but no untoward swings on a year-on-year basis. Delving into the detail a bit more and diving into the countries, let's once again begin with Germany, a key European market and the largest economy on the continent. We've seen a concerning trend here. 11.5% of German companies are in distress, the highest percentage since the pandemic began 5 years ago. Staggering 18% of underperforming businesses are now in distress, which is a significant jump from 14.3% just last year. In our dataset, the specialized retail sector is the most distressed in Germany. Some topical names, which I'm sure you're all familiar with, are Taco Fashion, Galeria Kaufhof Signa, Gary Weber, and Peek & Cloppenburg. Unsurprisingly, we've also seen increased distress in the automotive and manufacturing industries, with, for example, restructurings for Eismann, Leoni, Warta, KTM in Austria, and this year, of course, the ongoing restructuring of automotive supplier Webasto, where our colleague Johann Stoner is serving as CIO. These sectors, particularly those that are export-orientated, are struggling with rising energy costs, intense global competition, and a drop in demand from key markets like China. These pressures are only compounded by the threat of new tariffs, and that, as we all know, is unforeseeable on a day-to-day basis. We don't have our French colleagues here with us today, but let's turn our attention to France. Here, distress has been a growing challenge. We've seen a 30% increase in distress compared to fiscal year 2023, with 10.5% of French companies now in this distress category. The number of underperforming businesses has also risen sharply to 14.6%. What's the reason for that? Like Germany, French firms are also struggling with the second weakest balance sheet robustness amongst the countries we analysed. In industry terms, it's healthcare that provides the most distressed industry, followed by media and entertainment, which also includes telecoms. There are a large number of very topical French restructuring situations in these sectors, such as Cerba, Orpea, Colisée, Sequence, along with Altice and Atos respectively. This is amongst others due to rising operational costs from salaries and energy to rent, which are hitting capital structures particularly hard, since many are and were already heavily indebted. This is all happening against a weakening economic backdrop with rising inflation, low GDP growth, and a climate of political uncertainty affecting both businesses and consumer sentiment.
Thanks, Christian. Finally, let's look at the UK. We're seeing distress levels down from last year, with 9% of businesses in distress. While there is a slight improvement there, it still represents one of the highest percentages in our analysis. This moderation could be a result of the improved visibility following last year's general elections and the US elections. However, we expect a different picture in 2025. UK businesses are already feeling the strain from higher labour costs and persistent high inflation. The Bank of England has been holding rates high, saying inflation is not out of the woods yet, which will continue to impact consumer spending. In terms of the sectors, and a follow on from that consumer spending comment, fashion retail is the most distressed, with 1 in 5 businesses currently in distress. We've seen businesses such as River Island, Superdry, and Ted Baker all facing recent challenges. This is followed by entertainment and media services sector, and that sector which includes the alternative network, fibre providers, and then chemicals. The struggles of the UK altnet sector will be very well known to many of us on the call, with names such as City Fibre and G Networks undertaking recent high-profile restructurings. Likewise, the challenges of UK chemical names such as Venator and Ineos are well documented. Colin, is there anything further for you to add?
I think maybe just to kind of offer, our perspective. I mean, first, as Chris said right at the start, as a rating agency, we look at everything we rate. So all of the bonds and loans that we have ratings on in Europe and globally, that's the basis where we start thinking about credit risk and defaults and things like that. So obviously there are some differences between our coverage and what you're seeing here from Alvarez and Marsal, but I think there are some commonalities too. So the things I'd point to are, at the moment, the level of distress or default that we're seeing in Europe is relatively low globally. So our global speculative grade default rate in our latest data, which is the 12 months to August of this year, was 4.5%, but it was a lot lower at about 3.25% in Europe. But within Europe, we saw a similar kind of split, with the UK being around the average, similar to some of the data you've just seen, and France and Germany seeing higher default rates. And over the past year, we've had some notable defaults like Thames Water, like View in the UK, La Financière in France, Arvos, Bitco and Midco in Germany. So it's a picture where I think we can see a similar pattern with a bit more distress in Germany and France than in the UK. But because we focus on what we call default rates, the measures are a little bit different. So maybe another comparison that might be useful here, gents, is I really like the slide you put up with companies lacking robustness, and you had that kind of over time. And I think that's similar to a metric we use, which is the percentage of ratings that we see which have a B3 rating or lower. So just in case you're not familiar with Moody's ratings, we have a scale that goes from AAA all the way down to C. B3 is quite a low rating. And that's, again, where we see numbers that are a little bit below a third. I think some of the charts you had around companies' distress were ranging between 28% and 32% over the recent years. But it's ballpark a similar kind of number. So in Germany, I think 28% of our current portfolio are B3 or lower. In France, it's similar. In the UK, it's a little bit less. It's about 26%. So there may be some timing differences here, and there's definitely some sampling and coverage differences. But I think the broad picture where we're seeing a bit more distress in Germany and France than in the UK is pretty much the same.
Thank you for that, Colin. Let's look at sectors then across the piece and across geographies. Looking at those sectors, financial health has declined in 8 out of the 16 sectors we have tracked. Once again, this decline is particularly notable in major markets like Germany and France. The entertainment and media services sector, including altnets, which we've already mentioned, is the most distressed, with about 14% of companies in this category. We've already mentioned some UK situations, but across Europe, there are also topical situations such as Infrafiber and Deutsche Glasfaser currently in focus. Follow closely is the retail sector, encompassing both fashion and specialized retail, which is struggling due to restrained consumer spending and evolving purchasing preferences. This sector also faces a high cost base and a need for significant investment in IT and cybersecurity, which is contributing to very thin profit margins. The chemical sector is also one of the top 5 most distressed, with more than 10% of firms in distress, largely because of high production costs from energy prices and aging plants, which has a direct impact on their competitiveness. This is being compounded by weak demand and declining business confidence. Topical distressed chemical names include DET and continue to include Chem1, Heubach, Arxada, OQ, and Domo Chemicals. We've also seen a notable increase in distress levels this year across several other key sectors, including automotive, business services, commodities, and manufacturing. Colin, your perspective on the sectors.
Well, again, I think we probably need to be a little bit careful, because precisely how you define these sectors is going to be a bit different in our data from what you see here. But again, I think there are some commonalities. So when we think about sectors at risk now, every month we publish forecasts for our expected default rates across different sectors. And in Europe right now, the sector where we're expecting to see the most defaults is containers and packaging. And of course, that will have strong links with the likes of retail in particular, but also some of the chemicals and other sectors you see here. Consumer durables, which of course is very much part of retail. That's one of the sectors we're highlighting. But there's also an issue around some of the coverage. I think the sample sizes here that you have are probably a little bit bigger than some of the sectors we cover. So for example, one of the sectors where we're forecasting a higher default rate at the moment in Europe is aerospace and defense over the next 12 months. But that's quite a small sector for us. It doesn't contain an awful lot of issuers. And it simply reflects, that high default rate simply reflects the fact that we have quite a few small rated entities in that sector who are kind of CAA rated, so right at the bottom of our rating scale or lower. So I do see some commonalities here. I think there is a bit of a focus around what I call discretionary spending, which we see in our data, and you can see here with media and retail and other things like that. And I think that just speaks to a little bit of some of the challenges we see across the European economy.
Thank you for that, and fascinating, slightly counterintuitive, given what's going on in the world geopolitically. Defense would have been one sector I would have tipped off to be in relatively rude health, but then again, that just shows how wrong you can be and how different methodologies can be. This is where we're trying to be a little bit interactive with you. So hopefully, if technology works in our favor, there should be a pop-up box appearing on your screen shortly, and we'd be very grateful if you could bear with us and cast your vote in terms of your expectations for the future for the next 12 months. Do you think that distress levels are going to increase significantly, moderately, stay broadly stable, or in fact decrease? Voting open now. Fascinating. Early results are in. This is like election day. And it would appear that pretty much just shy of 3/4 of you, going in that direction, are expecting a moderate increase of distress over the next 12 months, which in fairness, I think I can speak for certainly the A&M crew, is also what we thought might happen. And also to be taken with a pinch of salt, because as we all know, we're talking about a vast range of sectors, industries, and very, very different jurisdictions. But across the board, it looks like, in this group at least, the expectation is for a moderate increase over the next 12 months. Thank you very much, everyone, for participating.
There's obviously a bit of self-interest there as well from a couple of hundred restructuring professionals. Not saying there's going to be a decrease in restructuring activity over the next 12 months. Otherwise, what would we all be doing here? But anyway, look, thank you for participating. As Christian said, look, our view, kind of house view, is that we do expect activity to increase over the coming years. I think when we've definitely seen an uptick in that over the last 6 or so months. And, while financing conditions have improved and, we saw significant issuance over the summer, and there's still a lot of capital out there, leveraged finance markets continue to be bifurcated and highly selective based on the quality of the borrower. High quality, resilient businesses can secure more favourable terms and lower pricing. Weaker credits are those with exposure to geopolitical risks or cyclical revenues, face much stricter scrutiny and higher costs so they can get financing at all. In the UK, inflation has cooled slightly, but persistently high rates and sluggish economic growth make it very difficult for leverage firms with poor cash flow to stay afloat. The Bank of England said in the latest MPC meeting that inflation is not out of the woods yet, as I mentioned earlier. The UK's high government debt, it's nearly 100% of GDP now, and subsequent restrictive fiscal policy poses a major challenge for distressed corporates. High public debt drives up government borrowing costs, which keeps interest rates elevated for businesses, increasing their debt service burden and making restructurings more expensive. Further, the likely future of fiscal policy, higher taxes and constrained public spending will reduce corporate profit margins and squeeze the consumer even further, thereby accelerating the rate of insolvencies and intensifying the pressure on businesses.
Adding to that again from a in-country perspective on the continent, and Germany in particular, whilst Europe's largest economy, Germany, may not be in a technical recession for once, having been there before, it is facing a prolonged period of economic stagnation. The latest data shows a quarterly contraction in Q2 25, following positive growth in Q1. But this in turn follows 2 consecutive years of contraction in 23 and 24. I think as we all agree, this weakness is not merely cyclical, it is a structural crisis driven by significant challenges, including high energy costs, stiff global competition, and geopolitical uncertainties. Looking ahead, German economic institutes have a muted forecast with predictions for 25 to be the 3rd consecutive year of near zero growth or slight contraction, and an only marginally more positive outlook for the first 2 quarters of 26. This ongoing struggle marks the longest period of economic stagnation for the country since the Second World War. There is one theoretical bright spot, but question mark how real that really is, and perhaps more importantly, how quickly it will manifest itself. And that's the upcoming special budget or Sondervermögen. Germany's strategy to bypass its debt brake through large debt-financed off-budget special funds, primarily the Climate and Transformation Fund or KTF, presents a complex risk-reward profile. On the one hand, the commitment of over 150 billion in public investment for 25 alone into areas like renewable energy, hydrogen, and infrastructure creates a significant publicly backed revenue pipeline that may stabilize supply chain and development companies in the medium term. On the other hand, a key challenge and risk is the legal and political uncertainty surrounding these funds. As they circumvent the constitutional debt brake, their long-term financial stability and permanence remain subject to political negotiations, legal challenges, and the potential for future austerity measures, which could lead to abrupt changes in funding priorities for projects aligned on KTF capital. More immediately, the spending is meant to be for defense and infrastructure. And there are many automotive supplier companies in particular who I think had somewhat exaggerated high hopes as to their ability to shift existing production away from automotive and onto defense. So time will tell how real that really is and how immediate the impact and how many struggling companies will benefit positively from that additional opportunity. Infrastructure, on the other hand, tends to take time. Even if the investment happens today, it may take many, many years for positive impact to be noticeable in the day-to-day ongoing economy. So my personal concern is these are positive initiatives, but are they going to be as material and as immediate as people hope? Only time will tell. Turning to France, the number of corporate insolvencies and restructurings in France is on the rise, returning to levels not seen since before the pandemic. And we do see this trend to continue for a little while. This catch-up trend is largely being driven by a combination of factors such as prolonged levels of high interest rates and economic slowdown, putting pressures on businesses, the need for companies to repay deferred COVID-era debts, and a new, more efficient restructuring framework in French law. Not wanting to bore you with the mythical debt maturity wall, but we are seeing the general increase in leverage in the corporate sector, particularly for pandemic-era LBOs, leading to more distressed situations as that debt matures and refinancings are not so easy to come by anymore. A few words about tariffs, even though it's anyone's guess, as we all know. The impact of tariffs appears to be very uneven across Europe and the UK, obviously depending on the level of reliance to US exports and key industries. We may begin to see further trade tariff impacts such as increased costs, lower demand, and falling profit margins, and knock-on effects such as supply chain disruption, economic contraction, and retaliation in the form of trade war. Countries with significant trade surpluses with the US, such as once again Germany and Ireland, could be hit hardest, as well as sectors like steel and aluminium, and of course, once again, the automotive industry. So sitting here in Germany, once again, it could be just another factor exacerbating a perfect storm. Finally, a few words on the oft-touted liability management exercises. US-style aggressive liability management exercises are increasingly prevalent in Europe, driving a shift in traditional restructuring approaches. Some recent notable examples that you'll all be familiar with include Altice, Stonegate, Ardagh, and Hunkemöller to illustrate this growing trend. And as we all know, sponsors and shareholders are capitalizing on the flexibility embedded in their debt documentation, and this evolution is reshaping the restructuring playbook. High debt loads, weak covenants, and expensive refinancings are not expected to disappear soon, meaning we'll see LMEs set to rise. Having said that, I also think there's a notable difference in jurisdictions once again. There's a reason why we've seen them in France, we've seen them in the UK, begun to see them in the Netherlands and in Ireland. My personal vote would be that I think Germany won't be the next country where we'll see a whole spate of them, because once again, the European jurisdictional landscape is quite varied. But fascinated to hear Colin's views on some of these themes.
I mean, you've covered a lot of ground here, gents. I mean, maybe to start with, just bringing it back to what we focus on, which is that kind of default rate for Europe, which I said was about 3.25 in the 12 months to August 25. It was higher a year ago if we think about some of the timing differences between our data and yours. But actually, our baseline forecast for that default rate in our rated universe over the next 12 months is that it will probably decrease, if anything. And that's against a backdrop of a modest pickup in growth in Europe, but also the fact that the ECB is further through its loosening cycle than either the Bank of England or the Federal Reserve, for example. Rates have been cut more, and that will feed through more quickly to the businesses that have costs tied to that. But one of the things we do at Moody's, we know there's always a lot of uncertainty around credit risk, is alongside these baseline forecasts that we publish every month, is we also publish other scenarios. And in particular, we have something called a severely pessimistic scenario, if you think we might be hitting something like a big recession or another global financial crisis. And we also have what we call a moderately pessimistic scenario. And that's one where it's not a big shock. It's just growth being a bit weaker. It's markets in particular being a bit weaker and credit spreads widening. And in that kind of scenario, which is not extreme, it's not kind of highly unexpected at all, you do in fact get an increase in the default rate in Europe over the next year and a little bit beyond. So even though our base case is defaults might fall, I think we're well aware that it wouldn't take much to knock us off course and we get more of a rising default rate instead. And again, there's some differences here in terms of our rated universe versus some of the broader topics that Chris and Christian are covering here. I think we totally agree that the share of companies in distress, that kind of B3 and lower metric that I talked about from our side, that will remain high, and we don't see that shifting much at all. It's interesting that I think maybe three other points just to pick up on some of the things you talked about, gents. I mean, firstly, in terms of funding costs for companies, obviously we are seeing some upward pressure on benchmark rates, which are the yields that governments pay on their debts. We often look at 5 or 10 years or even 30-year yields on that stuff. But credit spreads, both in Europe and in fact in the US, the extra kind of compensation you get for risk above those benchmarks for corporates remain pretty tight. And there are different ways you can measure that. So if you looked at spreads relative to swaps, they're a bit more like average levels. But credit spreads so far remain tight, and that's helping to offset some of the upward pressure on yields, on corporate yields that we've seen from benchmark rates. I know Christian mentioned, he didn't want to bore you all with the debt maturity wall. We're obsessed with things like that at Moody's because, we really care about liquidity. So in terms of our rated universe, there's not a lot of debt that needs refinancing in 2026, which is what you'd expect because you don't really want to leave it to the last minute. You want to get ahead of these things. And I would say for us, there's a bit more in 27, but when I look at the data, I think it really starts to build more into 2028 and beyond. So there is a bit of time for some of these issuers that might be at risk to try and address things. And you need the same two things you always need there. You need a great story about you, and you need the market to be in your favor. You need the market to be open and liquid and investors to be interested in that kind of risk, in that kind of profile that you offer. And finally, just a word on, I love the phrase liability management exercises. At Moody's, we call those defaults because whenever you swap an existing financial obligation for a new one which has a decreased financial value, there's a pretty good chance you'll be doing something that we call a distressed exchange. And just to echo Christian's point here, if I look back in our data kind of 20 years ago, these distressed exchanges or DEs, I think they were well under 10% of the defaults that we recorded, as compared with bankruptcy or liquidation filings or missed principal or missed coupon payments, the kind of easier stuff. Today, around 2/3 of the defaults that we see globally, and it's a little bit lower than that in Europe, I think, but it's not a long way below that. Around 2/3 are these distressed exchanges, or if you work for private equity, a liability management exercise. And we absolutely expect that to continue. So in terms of what Chris and Christian have been talking about with increased restructuring activity, I absolutely agree. I also think Christian's really right to call out the difference in the legal jurisdiction here, because that makes a big difference in terms of people's willingness even to look at this at an early stage, let alone to then follow through and execute. But maybe I'll stop there if that's okay, gents.
Okay, thanks, Colin. Look, I think that's it from a sort of a presentation perspective from us. Look, I think what we should turn to now, and hopefully some of that has resonated with you, and maybe you've got some different views or questions that are coming out of that. Please do continue to populate the question and answer box. We've got a little bit of time left now as well. And it'd be good to kind of hear from you as well on the areas that you are keen to focus in on. We have had a couple of questions which we will run through now. I'll kind of read them out, and then perhaps Christian and Colin can pick up on them to a certain extent, and I'll give my views as well. Why don't we start with the first question we've got, and just bear with me as I work through our system to pick it up. We've got a question on tariffs here, actually. So given the question is, given the uneven impact of tariffs across Europe, which industries or regions should lenders prioritize for risk assessment? And Christian touched on it a little bit in his presentation earlier, but I'm not sure. Colin, do you want to have a crack at that one in the first instance?
Yeah, sure. I will start by echoing what Christian said, because I think he was spot on. The way the Trump administration is approaching tariffs, you have the kind of blanket numbers which apply to the individual trade deals that the US is seeking to strike with individual countries. Although, sometimes the degree of detail in those deals is a little bit less than we're used to. And just as importantly, I think Christian made this point as well, even when you have a deal, it's not as if the degree of uncertainty around future US trade policy is significantly diminished. President Trump is using tariffs not just to talk about trade, but to talk about legal processes in Brazil and India's purchases of Russian oil and all kinds of stuff. So even if you have a trade deal, it does not mean that you will not be hit with further tariffs in 6 months' time or a year's time. So the uncertainty here is just as important. And indeed, when we think about the macro consequences, that's one of the things we've called out a couple of times as being very important. But I think it is the Section 232 tariffs where probably the administration is on firmer legal ground. Obviously, we're seeing the challenge on the generic tariff policy has, I think, now gone to the Supreme Court, but I don't know when we're expecting a ruling. But in terms of the legal structure, the Section 232 tariffs, sorry, that target specific sectors, like the news we've just had on pharmaceuticals, I think those are very, very important. And that's why if you are using steel or aluminium products and exporting stuff to the US, if you're in the pharma sector and you're trying to send stuff to the US, that's where we see more risk here. And the challenge, of course, is that it does seem to be a very transactional approach from the US administration. So one of the things that struck me about the recent announcements on branded pharmaceutical tariffs that the administration is trying to bring in is, if you're a European company, you can get around that by having a factory in the US. So it's a complicated field. But the thing I would say is, when we looked across our universe of ratings, because obviously when, even before President Trump was elected for his second term, we were doing the work on what the policies might mean and where the impact might be. So we have run the rule over our entire corporate universe of ratings globally to try and get a sense of the risk here. We don't think it's that substantive yet. If you were already a struggling corporate, so you're probably rated B3 or lower on our scale, this makes life a lot worse for you. But the wonderful thing about working with credit ratings that, of course, we make up ourselves, and sorry, they're not made up. There's a methodology, there's a process. But the big thing about ratings is we have a nonlinear scale. So when you're at the kind of B3 and lower level, we're already signaling a high degree of credit risk. We're already signaling a high probability of default and distress and losses for investors. And so tariffs are making that a bit worse. But I think in most instances, we're thinking about the impact on average being at most maybe a notch on our rating scale. So there's a lot of noise around tariffs. Certain sectors will clearly be more at risk, and the 232s are the thing to watch there. I think as much as that impact, we are really concerned about the impact of the uncertainty that persists even when you have announcements of trade deals or tariffs being in place.
Yeah, thank you, Colin. Very comprehensive.
I think that resonates. Just to add to that, that was pretty much what was going through my head from a German perspective. Most of those industries, possibly pharma accepted, because that did come as a bit of a surprise. But if you think about the usual suspects, it does seem to hit those who were already structurally struggling. So once again, we're talking automotive, steel, those sectors. And certainly automotive, in the automotive supplier space, does affect an awful lot of real jobs and real people. But the underlying structural issues, even prior to the whole tariff topic, were there. And there's a good chance that they've just been crystallized and accelerated and ultimately manifesting themselves somewhat earlier than they would otherwise have done. Yeah. Sorry, Chris, back to you.
No, thanks, Bo. I think some really valid points there. I mean, another sector that kind of is impacted by tariff is undoubtedly going to be renewables, and we've had a question directly on renewables as well, which is, given the current economic landscape, what is your assessment of the risk to the renewable sector in the UK and wider Europe? And look, as I said, it's definitely a sector that we've seen, if I just pick up the question in the first instance, a lot of activity on over the last couple of years. And there is, Christian mentioned perfect storm earlier around the German economy. I think that could also be stretched out to this sector as well. The transition from an era of quite cheap money has exposed the capital intensive nature of these projects, and there's been multi-year rises in interest rates, which has directly inflated the cost of electricity, making projects just less profitable and harder to finance. A challenge acutely felt in offshore wind, and we've had a couple of situations where we've been involved in recently in that part of the market. And this interest rate inflation trap is compounded by persistent cost inflation, critical materials, copper, steel, lithium, and skilled labour shortages have eroded margins, leading directly to project delays, etc. It's a significant systemic vulnerability in that sector, I think, and as rising geopolitical risk also adds to it. Europe as a continent is heavily reliant on China. I think would be the other thing I would say, for low cost components. The race to kind of beat them and win against them when they are years behind, and also without the significant capital resource, has led to quite high level failures. Northvolt, obviously last year being one that kind of springs to the mind, but there's also been further distress in solar panels and batteries. And then there's the dependencies now driving sort of green protectionism, and there's policies in the US and EU as they try to protect that level of manufacturing. So I think another one that tariff comes into here, which could again increase kind of capex costs in the short term, directly undermining the speed and affordability of the energy transition. So you've got real project level problems there, where as I mentioned, extremely capital intensive, and there's only so far you can go in terms of supporting these businesses, and at some point there's got to be a decision made whether this project is viable or not. So we do see more coming through from the renewable sector in the sort of short to medium term. Christian, views on that?
I can only corroborate and reiterate that's exactly the case, and it is always challenging for stakeholders when projects were set up with relatively thin margins to start with, and then you ultimately get a few adverse impacts and you're sitting around the table and you've got to ask yourself the viability question. So that's exactly right. If time permits, there's still a way to negotiate a hopefully consensual answer out of it, but it does entail a redistribution of a shrinking amount of value, and very often it's difficult to find particularly creative levers over and above that. It really is dividing a smaller pie. And that requires, as we all know as restructuring practitioners, the time to actually get there. If not, you'll end up in situations such as Northvolt, where you end up in an in-core protection. And I think we'll probably see a few more of those going forward.
Okay, thank you. We've got one more question, and look, I think it's particularly pertinent given the audience, and I know there are a lot of lenders in all shapes and forms on this call. The question is, how should lenders adjust their strategies in response to the growing trend of sponsors, leveraging very flexible debt documentation to avoid defaults? Christian, do you want to have a crack at this?
Yeah, it's a bit of an unfair one sitting in Germany, because we've got jurisdiction coming to our aid to an extent. To an extent, it's also a double-edged sword, because in Germany, liquidity really matters. Liquidity and solvency is kind of the extra covenant that may not be in the docs, and that very often in our experience is actually driving restructuring situations. The downside to that is when liquidity matters, time's often very short, and once again it may not be in lenders' interests, because when that really becomes a driving factor, depending on how quickly management has acted, there may or may not be enough time to really intervene. In most cases, and back to the maturity issue that Colin mentioned earlier, people are circumspect enough to realize that in Germany, you've just got to act a bit quicker, regardless of what your covenant situation looks like. That, for example, you want to really refinance 18 months before your maturity and not just wait for the last 12 months. So if that's the case, you typically do have an additional driver of proactive restructuring situations outside of the documentation and regardless of covenants. That is not a luxury that is available to other jurisdictions, though. And especially in an Anglo-American context, people do sometimes leave it to the last minute in the hope of an on-market refi when that famous bond window opens again, or when the economy suddenly ends up looking a bit more chirpy than it did 6 months ago. And it's in those situations where lenders can find it increasingly frustrating to not really have the old-fashioned package of covenants and other early warning signs to come to the table. People organize nonetheless and agitate. Sometimes that's successful, sometimes it's not. But often in these early stages, you also don't really have the means to get your advisors properly engaged, to get the access to information that you need. So the level of frustration there can vary, once again, between jurisdictions. Colin, what's your view on those dynamics, once again, on a pan-European basis?
I think I should probably start with a point I made earlier, just in case any of my colleagues are watching this. You made the point about some of the sponsors maybe leveraging weak covenants to avoid default, and I totally agree on we published our own metrics on covenant quality and the degree of protection that provides creditors, and that's definitely decreased dramatically over, post GFC really, over the long term. So lenders have fewer protections. But just to reiterate what I said, when we see sponsors leveraging weak covenants to do something, we often call that a default. An LME is a default for us. So just to make that point again, when you're looking at our data, when you're looking at our ratings, that's factored in. I mean, it's certainly that approach to being more active is really, really important. But I think it's also important not to kind of overstate the problem here. So if I think about the people, the lenders here, I think I'd probably categorize them into two broad categories. One is banks, who are still big players in corporate lending in Europe as a whole. Debt funding or market-based debt funding as a share of corporate liabilities is still a long way below what it is in the US. It's still a bit behind where we are in the UK. So banks are often on the hook here when companies are getting into trouble. And they're even, when we're running the stress tests that I talked about earlier, which is something my team does, the corporate lending exposures don't look like a source of systemic risk for the banking sector right now, I would say. And some of that is down to the changes where under IFRS 9, of course, banks have to report stage 1, stage 2, stage 3 loans. And the stage 2 is where, you're a bit worried about it, but it's not totally bad yet. Of course, banks may be underestimating that. But when we run kind of our standard stresses where we run shock rates and higher loss rates or higher NPL rates through the lending portfolio, and we make an assumption about LGDs, I would say the European banking sector today is still much better capitalized and much better placed to withstand that kind of shock than it was in, say, 2005, 2006. So the world has changed on the banking side. And on the investor side, because the investors, the other people who have exposures here, they've given money to these companies. I mean, it's still true as a matter of maths that if you were earning an average spread of about 450 basis points over a safe benchmark, we know with a 5-year hold to maturity portfolio, you can withstand a 10% loss rate on that and still match or slightly beat the benchmark, right? So, it comes back to your risk appetite and how well you have calibrated your risks and controls around these things. But certainly you should be aware that this trend of active engagement and what we call distressed exchanges, whatever people call liability management exercises, that's here to stay. And you need to be ready for that, and you need to be ready to engage with that.
Thank you both. Yeah, I mean, look, I can only echo the sentiments then. Mentioned there, look, the kind of post-deal, well, origination, you can obviously try and tighten it up as much as you possibly can, but there's a recognition how competitive the marketplace is. For that, post-deal, you've got to be able to ensure that you're monitoring as closely as you possibly can, what's going on in that business, the KPIs, the management information, assuming that you're getting it. And of course, if it is starting to go the wrong way, well, you know where to come, don't you? So look, on that note, look, why don't we close off the call? We haven't got any further questions. Hopefully what we've talked through today has been clear, and as I said, giving you some food for thought, and has resonated as well with you listening in. Look, thanks for participating. Obviously, with the poll, it was quite clear where we think the activity is going to go. But that, as I said, there is some slight self-interest in that, albeit we do recognise that that's the market indication at the moment. Okay, look, thank you very much, everybody, for listening, and it's goodbye from us. Thank you.